US President Donald Trump has called the head of the US Federal Reserve, Jerome Powell, a major loser and asked him to cut interest rates immediately. This feud caused US markets to plummet overnight and the US dollar fell to a 3-year low. So what impact could this clash have on the global economy and Australia? I caught up with Kerry from JP Morgan a little earlier.
It's not unusual in the case of the US. The first time President Trump was in power back in the early 2000s, it was a case of thinking around his attitudes towards the Federal Reserve then. In fact, he appointed Jerome Powell as the chair of the Federal Reserve. There's a bit of a grey area when it comes to the authority between the US government, the White House, and what it does over the US Federal Reserve. It's meant to be independent. That's how central banks work, and that's how the policy is the most effective. But it is about legal challenges. And right now there is a legal challenge going through the Supreme Court, which could set a precedent for the ability for the president or the White House to be able to remove Jerome Powell. But until that actually happens, there's nothing to say that the president can oust the central banker from the Federal Reserve, and that monetary policy shouldn't continue to operate as it has been doing for a number of years.
Yeah, Trump's called him a major loser and said he's been too slow to cut interest rates. I mean, from Powell's perspective, though, is he doing the right thing here, watching, waiting and seeing what's going to happen with the US economy before making any big movements with the cash rate in the States?
Absolutely. They're thinking about their forecast for where both economic growth is going and inflation. Obviously, the consequences of the tariffs that have been announced are inflationary. We do see the inflation in the US heading back up towards 4% from roughly 2.5% today. The question is how permanent those inflationary pressures will be. And again, how much growth is damaged in the meantime. There's still a chance that the US can avoid a recession at this point in time. But if you do get that outcome of higher inflation, yet weaker growth, the central bank is likely to respond to that weaker growth and cut interest rates. But it's not going to do so because the White House is telling it to. It's going to do so because it thinks that's the best outcome for the US economy and for the US people. If we look at its mandate is price stability and full employment. And those are the two things which will drive its decision-making process.
Yeah, the next Fed meeting is in the first week of May, so it's basically just a few weeks away. Are you expecting them to just keep rates on hold this time around?
Yeah, we are expecting them to remain unchanged. I think the challenge for many market watchers and commentators, as well as central bankers at the moment, is that there's not a lot of economic data which captures the impact of the tariffs to really assess, to see which way the economy is moving. We only have survey data so far. Because we do have that 90-day pause on that reciprocal tariff, it means they're not going to come into effect until early July. And so it does push out the timing of that first rate move, perhaps towards September, maybe June, depending on how the economic data goes. But it's more likely to happen in June and towards September now. But those pace of rate cuts might be slightly accelerated based on the economy getting a little bit worse and having to wait for that clarity around how much economic damage has been done in the meantime.
This sort of public attack, though, from Trump on Powell really caused markets in the US, at least, to be sold off pretty heavily last night. It's created more volatility. I mean, how long are you expecting this volatility to continue for? Are we looking at months and months more here?
I think it's going to continue regarding tariffs and regarding monetary policy for a little while. The news flow out of Washington, out of the White House, has been erratic. It's flipping and flopping on the policy direction, and that can persist for some time, uneasing markets. I think the big takeaway, though, is that we're now in this period of just waiting and seeing what happens to the economy, waiting and seeing what happens to earnings outlooks and what the guidance we hear from US companies and international companies over the coming weeks actually does, and seeing the market digest that in terms of thinking around whether there's another leg down in the equity market or whether we're actually thinking about the bottom. Our view is that there's more scope for a bit more downside risk to this as it gets digested rather than thinking about upside at this point in time. And all the time in the background, I think investors are sort of questioning the sort of US exceptionalism story from the last 2 years, which has really held up markets and held up the US dollar, which has been falling a lot based on this idea that, international assets outside the US are probably a better place for now.
Yeah, I saw some research today that shows the Dow Jones index is about to post its worst month of April since the 1932 Great Depression. It seems like, though, the Aussie stock market here is faring better. Why do you think the ASX is performing better than the Dow?
The market here is a little bit more insulated. I mean, obviously, a lot of the effects of the policy announcements on the US are going to have a bigger impact on the US economy. It's going to create problems for US companies, whereas Australia, I mean, we have been hit with a 10% base tariff increase. Obviously, some industry-specific tariffs around steel and aluminium, potentially some around pharmaceuticals still to come. It's going to have an effect on Australia, but at an industry level, not at a national level when it comes to the growth outlook. And we have seen, again, those second-order effects, thinking around what it does to global growth, how China responds, potentially being somewhat of a tailwind for Australian markets as well. So if we do get a big fiscal stimulus package coming out of China that could be announced as early as this month, that's actually going to be supportive for the market here. In the meantime, you have seen valuations on Australian equities come down to a certain extent. And I think investors are still looking for defensive positioning in the Australian market if we look at the performance of some of the financial sector just today, and looking for that prospect of Chinese stimulus if we look at the materials and miners as well.
And just quickly, do you think the RBA could cut rates by 50 basis points next month?
I don't think they'll cut by 50 basis points. I think they will cut next month. There's always a risk that the central bankers, whether it's in Australia or the US, do one of these emergency rate cuts or an outsized rate cuts, and that can actually have a negative effect in terms of not creating that positive sentiment in terms of supporting the economy, but creating a bit more negative shock in terms of an unsurprised large cut that wasn't there really expected. They generally telegraph these things quite well. They want to dampen the market volatility around that move, and they really want to provide that guidance that says we're here to ease policy rates. We're going to do so gradually as the economy dictates it. We're not here to sort of scare the market with saying we need to do things faster or larger than we had anticipated just a couple of months ago.
Kerry Craig from JP Morgan Asset Management. Thanks for coming on the show.
Thanks, Ed.